Okay, get ready. Because the warning shot just fired by analyst Michael Oliver, it's probably the most urgent market forecast we've seen all year. Seriously.
It really is. He's not talking about some slow, gradual trend here. He's laying out a case for, well, an economic shockwave.
Yeah, specifically in precious metals. Oliver just presented this really specific, almost mathematically driven case for an absolutely explosive move.
And the headline grabber? Silver. He's saying a $200 price shock for silver is now, and this is his exact phrase, inevitable.
Inevitable. Wow. And here's the really wild part, the hook.
Hmm.
Oliver's arguing this huge wealth transfer, this total reset for silver. It isn't some 10-year thing.
No, not at all. He thinks the move is incredibly compressed, like it's going to unfold in just a few quarters, not years.
Corners, it's incredibly fast.
Yeah, and he's convinced the system, the financial and monetary backdrop, has basically already triggered the launch signal. His point is, if you wait for the mainstream to catch on, you've already missed it. The whole opportunity.
Okay, so our mission today is pretty clear and, frankly, urgent. We need to unpack exactly what Michael Oliver laid out in this analysis.
Right, we'll get into his historical blueprint, based on gold cycles.
And then break down this staggering 50-year error he sees in silver's price.
Exactly. And the single critical signal he's watching right now that he says is flashing green, like ready for launch mode, he really argues this is the moment.
The moment investors have been waiting for.
Okay. And look, because Oliver's signals suggest things are moving into this super compressed rapid fire phase where like days and weeks matter more than months, being aware right now is everything.
Timeliness is key.
Absolutely. So to make sure you're tracking these critical fast-moving market alerts, staying ahead of the curve, we really urge you now to subscribe.
Yeah, act quickly. Subscribe to Cred Edge. It's necessary info, especially when the market might be shifting gears like this.
Okay, so let's dig in. The foundation for Oliver's whole analysis is pattern recognition. He uses gold's long-term cycles, basically since ownership was legalized back in the mid-70s, as his blueprint.
Right, the historical map.
Exactly. And he zeroes in on two big prior moves to set the dimensional context. First cycle, 1976 to 1980. Gold went from a low, around $103, up to $850.
Oh,
Oliver clocks that as an eightfold dimensional move.
hold on, let's clarify. Dimensional move. That's not just the percentage gain, is it? It's something more specific.
Precisely. It's not just the raw percentage, it's the relative magnitude. The final multiplication factor of the cycle from its bear market bottom to the final peak. The time frame, whether it's 4 years or 10 years, matters less than achieving that dimension.
Got it. So the first big move was 8 times the starting point, dimensionally speaking. What about the second one he uses?
The second cycle, that was 2001 to 2011. Gold moved from about $260 low up to $1960. And here's the fascinating part Oliver points out. It's almost the exact same eightfold dimensional move. Again, even though this one took a decade, not 4 years, the magnitude just repeated itself.
Wow. Okay. That pattern repeating is, well, it's pretty compelling. So where are we now in that pattern?
Well, that's the kicker. He argues we're only about halfway through dimensionally. The last major bear market low for gold was $1,043 back in December 2015.
Right.
Gold's currently around, what, $4,200? So that's roughly a fourfold gain from that low, only 4 times.
Which means, if that historical pattern holds up, if history just does what it did the last 2 times with these eightfold moves, gold could be hitting towards something like $8,500 before the cycle tops out.
That's the argument. Dimensionally, the gold move is only half done.
$8,500 gold.
And Oliver really stresses why this is so critical right now. He points out that this current move is happening under global conditions that are way more dramatic than before.
You mean like central bank actions?
Exactly. Specifically, the degradation of money units. Central banks everywhere are just flooding the system. He says the backdrop is far more severe than what sparked those first 2 big moves. We've never seen anything quite like this level of global monetary expansion.
So the fundamentals could actually push it even further than the historical pattern.
It's possible. The analysis itself is technical, mathematical, based on the structure. But the fundamentals, they're like pouring jet fuel on it, as he puts it. Gold is just doing its job, compensating for monetary policy mess-up.
Okay, $8,500 gold based on pattern math is one thing. But you mentioned silver earlier and the contrast.
Right, this is where the story gets really interesting. Silver, the other money unit. It should be moving with gold, but Oliver says it's lagging, massively lagging.
How badly?
It's basically stuck. Gold's made that fourfold move from its low, right? Silver. It's been trapped in what Oliver calls this long, boring, range-bound reality. And get this, silver is only just now trying to emerge from a 50-year price range.
50 years. That's
Yeah,
incredible.
it's not normal. Not for something that's supposed to function like money.
We've seen other commodities break out of long ranges, though, haven't we? What happens then?
That's a key comparison he makes. Look at copper. Copper broke a multi-decade range around 2005, and once it broke out, the compensation was fast and violent.
How fast?
Copper quadrupled in like 6 to 9 months. It fixed its long-term price error incredibly quickly. Silver hasn't even really started that catch-up phase yet.
So there's this huge, uncorrected error building up for decades. And Oliver has a term for this, right? The idiot chart.
Yes, the idiot chart. It sounds provocative, maybe a bit harsh, but it's probably the most, well, damning picture of silver's current price reality.
What does it show?
He basically demonstrates that if silver had simply kept pace with the real loss of the dollar's buying power, tracking something like M2 money supply growth since 1980, it should mathematically already be trading over $200 right now.
Over $200 now, just based on inflation compensation.
Yeah. Silver's current price reflects this massive historical failure to adjust. And Oliver's point is that compensation is now overdue, and when it comes, it'll be compressed.
It sounds like the market just forgot about silver for decades. And now the math says a correction is unavoidable.
That's exactly why he emphasizes the compression. Markets that stay depressed for too long, they eventually overcompensate. Violently. His warning is, if you're waiting for this thunderbolt catch-up, you absolutely have to be positioned before it hits, not after.
Which brings us to the timing. How do we know when that surge really starts? What's the launch signal? You said it's not silver's price momentum itself.
Right, because technically silver's already kind of in a bull market trend. The question isn't if it's going up, but when does it go vertical? When does it go ape, as he sometimes puts it?
Okay, so what is the trigger then?
Oliver stresses this. The key trigger isn't silver's price chart alone. It's the momentum and dynamics of its spread relationship to gold.
The gold to silver ratio.
Exactly. The gold to silver ratio. That's the thing to watch.
Can you just quickly define that for listeners who might not track it closely?
Sure. It's simple. It just measures how many ounces of silver it takes to buy 1 ounce of gold. So when the ratio is high, it means silver is cheap relative to gold. It's underperforming.
And when silver starts outperforming?
When silver really takes off, starts massively outperforming gold, which is what happens in the mania phase. That ratio collapses. It drops fast. That's the signal.
And history shows this. What happened with the ratio before those huge silver spikes in the past?
Well, think about 1979-80 and again in 2010-11. Silver famously tripled in price in just like 5 or 6 months, both times. Super vertical moves.
Right.
Oliver points out that both times that final parabolic explosion was signaled when that spread, the ratio, started collapsing aggressively. It signaled this huge shift, people piling into silver because it's seen as the cheaper, more leveraged way to play the monetary crisis. The ratio led the way.
Okay, so the ratio collapsing is the historical tell. What's the ratio doing now? What's the current posture?
He says the ratio has bottomed and is currently coiling for launch mode. That's his phrase. He's watching very specific momentum metrics of that spread. Not just the ratio level itself, but the speed at which it's changing.
So the velocity of the ratio is declining.
Precisely. He needs to see a breakout on those momentum metrics. Once that velocity picks up and breaks certain technical levels, that's the signal that silver is, officially breaking out of that 50-year cage and entering a totally new price reality, a very compressed one.
Okay, this shift into launch mode, the need to watch momentum metrics.
Yeah.
It really highlights the need for timely info.
It really does. Because these signals are emerging in what's likely to be a volatile, fast-moving environment, you need that data quickly.
So we need to quickly remind you again, Oliver's updates on these exact launch metrics are critical. If you want to get those alerts, make sure you're ready when the market potentially enters this vertical phase he describes. You really should subscribe to Cred Edge now. Don't wait on this.
Definitely. Okay, so let's talk about the ride. Because this kind of move isn't smooth. It brings anxiety, right? We've seen some nasty drops recently.
Yeah, those 5% or 6% sell-offs just this past week. One early in the week, another on options expiration. A sudden 6% drop makes a lot of people think, uh-oh, maybe that's the top.
Naturally. That volatility feels scary. It's designed to shake people out, isn't it?
Feels like it.
But Oliver looks at those drops completely differently, counterintuitively. He points back to 1979, 80, and 2010, 11. During those final explosive moves, they saw maybe a dozen, maybe 20 of those same scary-looking, sharp 5% or 6% breaks on the way up. He sees them as totally redundant historical patterns. They're actually a necessary part of the vertical surge, not a warning sign that it's over.
Wow, that requires a huge mental shift. Your gut screams panic when you see a 6% drop.
Totally. But his advice is pretty blunt and kind of provocative. He says you do far better buying the 5 and 6% breaks than you do buying upside breakouts.
By the fear, essentially.
Yeah. He basically suggests buying when your friends are yelling, "It's the top," because that volatility, that fear, that's actually what often precedes the final steepest part of a launch.
Okay, so let's bring it all home with the math. Recap the forecast. He's saying $100 silver minimum, but $200 or even more is realistic. And fast like a couple of quarters. How does the gold target help prove that $200 isn't just hype?
Okay, so we use that potential $8,500 gold target as our anchor. Remember, that's just based on gold repeating its own historical dimensional move from the last two major cycles.
Right, the eightfold move.
Exactly. So if gold hits $8,500, we then look at silver's historical relationship to gold's price.
And what is that historical relationship typically?
Oliver points out that over the last 50 years, silver has spent about 20 of those years, roughly 40% of the time, trading at 2% or more of gold's price.
Okay, 2% of gold's price as a sort of historical norm.
A conservative norm, yeah.
Yep.
So if gold hits $8,500 and silver just gets back to that long-term average, that 2% level, do the math. 2% of $8,500 is $160 for silver.
Whoa, $160 silver, just by returning to a multi-decade average relationship with $8,500 gold. That's nearly 5 times today's price.
Exactly, just returning to normal.
Yeah.
But then you look at the extremes during past bull surges, like back in 1979-80, the ratio got much lower, meaning silver got much more expensive relative to gold.
How expensive?
Well, the ratio implied silver was worth well over 3% of gold's price during those peaks. So if silver just revisits 3% of an $8,500 gold price, you're mathematically well over $200.
So the $200 plus isn't just pulled out of thin air. It's based on gold repeating its pattern and silver returning to relationships seen in prior bull markets, driven by this compressed timeline.
It's the math needed to compensate for decades of market error, all happening much faster this time. It will be highly compressed. Oliver warns people are just going to wake up one day and find themselves in a totally new price reality. Just like happened with copper back in '05.
And if you're not positioned before that thunderbolt hits.
The opportunity for this kind of potentially generational wealth transfer, it's just gone, missed entirely.
Yeah, okay. So we've got a potential $200 silver price, mathematically plausible within maybe the next 6 months, based on this historical pattern analysis. It leaves you, the listener, with a pretty stark choice, doesn't it?
It does.
Do you wait for confirmation? Wait until silver's already making headlines at $100 or more and risk getting in near the peak? Or do you consider acting before the main blast, recognizing this specific setup? Oliver says only happens maybe once or twice in a generation.
Oliver seems utterly convinced this is it, that the market is finally set to correct that huge, long-standing valuation error in silver, and much faster than almost anyone thinks possible.
The clock really does seem to have started on this final phase. So one last time, to ensure you catch any of those upcoming launch signals, to get Oliver's critical updates on those specific momentum metrics, you need to be prepared.
Yeah, act now. This is the final urgent reminder. Subscribe to Cred Edge. Stay sharp. Stay aware.
Thanks for listening.